Okay, so here we are with my market update. Let's talk about the CPI, which is the Consumer Price Index. It measures inflation. It came in hotter than expected. The Consumer Price Index was up 0.3% in April. It has decreased year over year from 8.5 to 8.3%. Even though it declined, it was still hotter than the expected of 8.1. The core rate, which strips out food and energy prices, was also hotter than expected. And let's remember that mortgage interest rates do not like inflation. Interest rates are almost 2.5% higher than they were 1 year ago. Refinances fell 2% this week. They are down 72% year over year, and we are noticing that for sure. ARMs are gaining momentum as interest rates are on the rise. They are making up 11% of transactions, which is common when interest rates are rising for people to choose ARMs, like a 5-year ARM, which is fixed for 5 years, and then they can hopefully have an opportunity to refinance into a fixed rate. The Producer Price Index, which measures inflation on the wholesale level, it rose 0.5% in April, which was also hotter than expectations. Update here, Jerome Powell gets voted in for another 4 years as the Fed chairman. Let's talk a little bit about affordability. We are hearing big concerns about affordability, and for sure, there is no denying that affording a home is harder now with higher interest rates and higher home prices. We do feel the affordability index can be a little bit skewed. They said that only 48.7% of homes sold in Q1 2022 were affordable to families earning the median income. And as that also includes incomes at the lowest level, such as fast food workers and that level of income earners. So here's the thing. Unfortunately, not everyone is a home buyer. So if you were to take out those, like that bottom third of the income earners, the affordability index would be a little bit higher and a little less skewed as we see it. So there is no denying it's difficult to rent or to buy right now. New rents, that's people that go and rent a new place. Those rents are up 17%, with renewals of rent being up 11%. So if I have a year lease and I renew it for another year, I can expect that my new rate is 11% higher than the previous year. So with this comparison of home prices being up and rents being up, affordability is the same with both. And so personally, I've compared it. I've looked at rent right down the street and compared what you can get in a house at the same payment. And trust me, you can get a whole lot more for the same payment. So I can confidently say it still makes more sense to buy a home than to rent. You can lock in on a price, you can lock in on an interest rate, and then you have a good feeling of what your overhead for your household will be. And it won't be like a runaway train that it's going to go up every single year like rents can. And the other thing is, there is a high probability that in the short term, say a couple years or so, that there's a good opportunity for a refinance. So lock your price of your home in now, and then you know your payment at the current rate. So if there's an opportunity to refinance in the somewhat near future, then you're going to lower your payment. And also, if you get PMI right now and we see appreciation like we have, you'll be able to drop PMI pretty soon after acquiring the home as well. We just came off a year of 19% appreciation. We don't expect that to continue, but someone that bought 2 years ago and got PMI could almost get it dropped now, and they probably could. So that sometimes makes up for a couple $100 in the mortgage payment. And then the other thing is that you build wealth through that appreciation and equity that you build in the home. So you're not going to get that with rent. So hands down, I can confidently say when you make the comparison, if you are planning to stay in the house 5 years and probably even a little less than that, you're going to make out with buying a home. To give you an example, even at modest appreciation of just 3%, which we're seeing so much more than that right now. If I bought a home today at $300,000, at year 5, it would be worth $345,000 at a modest appreciation of 3%. That is like the average appreciation historically. And currently, we just came off a year of 19% appreciation. So I could talk to you about that all day. So if you have questions, definitely get in touch. A little more talk of rising costs. So we hear it. All costs are going up. Moody's Analytics reports that the average household is spending $311 more per month on such things as goods, food, gasoline, and things like that. As of Friday, the average at the pump was $4.50. And if you're wondering how gas is calculated, get your pencil out. I know I had to. It's the price of crude oil, which is $115. It times 1.5, which gives us the price of refined gasoline. We divide that by 42 gallons in a barrel and add about 80 cents for costs and taxes. And that's the price that you will come up with at the pump, which is roughly $5. So that's how they calculate the price of gasoline that we see at the pumps. There are some talks that Shanghai, which has been shut down completely due to COVID, they may be opening in June. They have been completely locked in their homes using very little energy. So once they reopen, if this happens in June, it may cause a surge in energy prices and in turn inflation. We are seeing a weakness through the economy, including manufacturing. We just got the New York Manufacturing Index and it is down 12 points for that one region. So we do want to keep an eye on that to see if it begins happening in other regions such as Philadelphia and other areas. This could be another recession indicator. We're seeing some weakness in consumer confidence. The April index, which is measured by the University of Michigan Consumer Confidence Index, it was at 65 and it came down to 59, which was below expectations. They asked individuals in this polling, is now a good time to buy a home? And that fell 14 points to 48. And that's the lowest reading on that index since 1982. And I just have to point out here that even though it was really low in 1982, those people that bought homes at that time, they made out really well. They saw a great amount of appreciation over the next 5 years. So that could be something that looks like it's going to repeat itself. It bodes well for housing with low inventory and growing demand. While it is difficult to buy a home right now, it does really bode well for home ownership, buying a home, and growing wealth through real estate and strong appreciation. The builder sentiment for the month of May, which we get from the National Association of Home Buyers in real time, it kind of tells us how consumers are processing what's happening in the marketplace, and especially with rising interest rates. So what they're saying is that it was not that bad and it was not that great, so it was kind of cool. And the index is from 1 to 100. Keep in mind that anything over 50 is expansion, which is good. The reading was 69. The expectation was 75. So it is a good number, and it's definitely a good number in general. It's just a little calmer compared to what we've seen just over the last short term of 2 years. But relatively speaking, over the long term, that's a good read. Also, there's buyer traffic, which gave us a reading of 52. Still an expansion, but at a much more reasonable pace. So that's the buyer traffic the builders are seeing come through, like the model homes and things. And we got a retail report. Retail went well. People are still shopping. For the month of April, it was up year over year 8.2%, and it was up 7.3% in March. Margins are shrinking though, as reported straight from Walmart, and they can only shrink margins so far before they have to pass that on to the consumer. So that could result in more inflation. And lastly, as we talk about housing and forbearance, the number of households that are in forbearance currently are 470,000. This is the lowest reading since they started this reading in June of 2020, because forbearance became a thing right after COVID started. They were trying to come up with ways to help people should they need it. The last report we had on forbearance was over 1 million households were in forbearance. So that is playing out just as we expected, and it is unwinding gently. So that's all I have for the market update. Please be sure to join me next time. Talk to you soon.